Good day and welcome to our special edition where we focus on renewable energies. Today, we turn our focus to a global leader in wind energy, Vestas Wind System. Founded in 1945 in Denmark, Vestas began as a manufacturer of household appliances and hydraulic cranes. But since the 1970s, the company has been at the forefront of renewable transformation, designing, producing, and servicing wind turbines around the world. With over 188 gigawatts of installed capacity across 88 countries, Vestas has not only grown its global footprint, it's shaped the entire wind energy landscape. Vestas' business model operates on two robust pillars. The first, power solution, generates nearly 80% of the company's total revenue. This includes the design, production, and sale of wind turbines. The second service contributes to the remaining 20%. This includes turbine maintenance, performance monitoring, and software support. Together, these segments cover the entire life cycle of a wind power plant and create a balanced growth engine combining large-scale installations with long-term recurring revenue. The wind industry is at a critical inflection point. Global momentum around net zero targets combined with government incentives and public pressure is pushing wind to the center of the energy transition. Still, the sector isn't without its hurdles. Permitting delays, supply chain pressure, and high capital requirements are persistent challenges. Yet, countries like Germany and China continue to ramp up investment, recognizing wind as a key path to energy independence. The US, however, are on an unknown path with recent political aspects affecting investments. Within the fast-moving landscape, Vestas stands as the largest and most globally diversified turbine manufacturer. To get a better understanding of external factors, Jade Robert Dugardier, a macro specialist from the ECB.
Thanks, Adrian, for having me. As the world is pushing the energy transition from fossil fuels to renewables, wind power's potential as a mainstream energy source is increasingly recognized and exploited. Not only is renewable energy's potential and widespread acceptance supported on social and environmental standpoints following climate action movements and anti-nuclear campaigns, its use has also become necessary to meeting global demand while honoring energy targets and commitments to reduce CO2 emissions. That being said, demand for wind energy solutions is primarily driven by governments who are leading the energy transition through substantial investments, subsidies, and tax credits. The attractiveness of wind energy is highlighted through the willingness for nations to lower their dependency on oil-producing countries, thereby limiting their exposure to geopolitical tensions and energy supply shortages associated with traditional energy supply. In addition to supportive policies, regulatory frameworks facilitating permitting and patenting processes create a stable environment fostering progress. Increased public and private capital flows going towards technological improvements are also paving the way for sustained growth of the wind energy industry. Since 2024, the ECB's decision to lower interest rates has also had positive impacts on capital-intensive industries, reducing borrowing costs and allowing further investments into new onshore and offshore wind energy projects. This economic stimulation policy will enable European leaders such as Vestas to pursue their expansion plans and growth objectives. Nonetheless, given Vestas operates on a global scale, it undergoes exposure to global market fluctuations. The company is, for instance, sensitive to currency valuation changes, which ultimately impacts its revenue and cost structure and might squeeze its margins. Moreover, recent policy shifts and trade barriers imposed by the United States threaten to significantly affect operations and upcoming orders in North America. The tariffs that were announced introduce fear of an inflationary pressure on supply chains, namely raw materials, costs, and electricity prices. The overall uncertainty surrounding the future of the wind industry under the Trump administration and the expected shift back to fossil fuel production is expected to be leading to a setback on wind power investments in the area.
Thank you, Jade. Moving on to Vladislav, our next panel expert, who will detail the government structure at Vestas.
Yeah, thank you for having me. So for Vestas, they follow a two-tier governance model with the board of directors overseeing the strategic direction, and while the executive management, they have a team to responsible for the daily operations. And we have also a set of specialized committees further reinforcing the board oversight and ensure effective check and balances. This structure promotes accountability and reflects recognized governance, which are the best practices within the wind industry right now. Strong governance design helps reduce agency risk, build investor confidence, supporting long-term financial stability and performance. For the board composition, we have 12 members. All shareholders, elected directors are independent and non-executive, ensuring impartial oversight. Gender diversity is strong with 7 women and 5 men, but the board lacks national diversity, with all the members are Danish or Swedish. This limited international representation may reduce global insight and restrict the board's ability to guide long-term international strategy. In today's globalized market, narrow board composition can weaken cross-decision-making process, potentially affecting expansion, risk management, and investor perception, all of which can carry long-term financial consequences. Vestas executive payment, they go through short and long-term incentive schemes. The short-term incentive schemes, they are 90% based on EBIT and 10% on avoided greenhouse gas emissions. We know that in 2024, these guides they missed the target, so there was no payout. For the long-term incentives, they are basically based on financial KPIs as the earnings per share, return on capital employed, and market share, but without any ESG-related metrics included. This lack of sustainability-linked incentives may weaken alignment with Vestas' environmental mission and raise concerns about the ESG-focused investors, potentially affecting the long-term valuation. Vestas has one share class, with each share carrying 20 votes. It's fully free float, present on NASDAQ. The institutional investors, they hold 22.7% of the shares, with the traditional investment managers making up the majority in this group. Most decisions require a simple majority, but changes to the statutes in the 2/3 of the vote. Institutional ownership adds stability, but concentrates also influence, which can steer financial and strategic decisions. The top shareholder still is BlackRock, holding 7.6% of the shares. Other long-term investors like Vanguard and Baillie Gifford also play a key role in the governance, providing strong oversight, but also they expect consistent performance from the management team. Falling short could trigger investor pushbacks and stock volatility.
Thank you, Vladislav. To continue, Luca Soriano, how has Vestas performed during the last 12 months?
So Vestas had a solid year across the board. According to the 2024 annual report, revenues were up 12.4%, reaching just over 17 billion euros in total. That growth was primarily driven by Power Solutions segment, bringing in roughly 80% of total revenue. That part of the business grew 15.1% on a year-over-year basis, mainly thanks to a higher average price per megawatt and a slight uptick in deliveries. Now, on the profitability side, gross margin improved to almost 12%, which is a meaningful jump from around 60% from 2023. But it's worth pointing out that the production costs still make up more than 88% of the total revenues. At the bottom line, net margin increased to 2.9%, up from just 0.5% in 2023. That is a strong signal that they are now starting to convert top-line growth into sustainable profit. What really stands out, though, is the return on equity. Return on equity jumped to 16.2% in 2024 compared to just 2.6% the year before. That tells us now that Vestas is generating significantly more value from its equity base. Now, looking ahead, most projections in the renewable space, including Vestas, stretch well beyond 2030, the year anchored to the global net zero agenda. And while there is a strong momentum, we think that it's important to treat those long-range forecasts with some caution. Between now and 2030, the outlook is clear. We expect wind demand to stay strong, supported by public policy, regulatory incentives, and energy transition goals. So we're comfortable projecting a compound annual growth rate of around 9% for revenues through 2030. However, post-2030, the outlook gets much more uncertain. Whether government actually deliver on net zero target plus what will happen after the year 2030 are the big execution questions. That said, we still see wind and Vestas in particular as a core part of future energy mix. But we're taking a more conservative stance on long-term growth. Instead of assuming a high expansion after 2030, we believe a 2 to 3% annual growth rate is a more realistic baseline given the uncertainty.
Thank you, Luca. We now have the immense pleasure to receive Nance Garrillon from JP Morgan, investment specialist.
Thanks, Mr. Fernandez. I will walk through the investment opportunity in Vestas based on a technical and sentimental analysis. As you can see on the chart, Vestas has been in a long-term downtrend since 2021, characterizing with lower highs and lower lows. However, the stock is now approaching a major support zone at around 80 Danish krone, which could signal that a bottom is near. Additionally, the monthly RSI has recently dropped to 30 points, which typically indicates an oversold situation. The last time we reached such a level was in 2012, right before a bullish reversal. On shorter time frame, we are also seeing a bullish RSI divergence, suggesting that buying pressure is coming back. For more conservative investors, I would watch for a golden cross that could happen based on my analysis. Let's now take a look at the overall market sentiment. The fear and greed index is still in the fear zone, but that's an improvement from the extreme fear last month, driven by macroeconomic uncertainty around Trump's tariffs. This shift reflects a gradual return of investor confidence. But be careful, there always are uncertainties that could still affect stocks. Another indicator that I wanted to share with you is the PE ratio. Vestas has currently a trailing PE ratio of 24 and a forward one of 13. A lower forward PE ratio signals expected growth and a possible recovery. Therefore, given the strong fundamentals, promising industry outlook, and current technical signals, we see a compelling opportunity. Vestas offers an attractive entry point, and we issue a clear buy recommendation for long-term investment. For current shareholders, stay invested and trust the recovery ahead. Finally, as Warren Buffett's words, be greedy when others are fearful.
Thank you, Nance. This brings an end to our special edition on renewables. I'm Adrian, your host, and be sure to tune in next time.